Your credit score is probably not what you think it is. You open your banking app and you see a 740, so you feel great. But then you go and apply for a mortgage or a credit card and you see that the lender pulled a 690. Now you're confused, maybe even a little upset, and you might think that somebody made a mistake. But in reality, nobody made a mistake. And by the end of this video, hopefully you'll understand why that happened, what your credit score actually is, how it's calculated, how to improve it, and why you should freeze your credit report today. So let's get into it. So first, let's understand what a credit score actually is. It's simply a score between 300 and 850 that lets lenders know how risky you are as a borrower. The higher your score, the more they trust you. And the more they trust you, you'll get better interest rates, better loan terms, and maybe even access to more loan products. Now, a 50-point difference in your score when you're applying for a mortgage loan makes a big difference because you'll qualify for likely a better interest rate, which could save you thousands of dollars over the course of the loan. Now, here's where people get confused. There's not just one credit score or scoring model. There are two major credit scoring frameworks, FICO and VantageScore, and they each have multiple different models depending on whether you're applying for an auto loan, a credit card loan, mortgage loan, or something else, and they each will be calculated slightly differently. This is why the score that you see with your bank is not always the exact same score that gets pulled when you're applying for a loan or some form of credit. Now, up until recently, mortgage loans only would look at FICO score, but a few lenders, as of lately, have started accepting VantageScore as well, which has helped a few borrowers increase their scores and get better rates. Now that we understand what a credit score actually is and why the score that you see in your banking app is not always the same as a score that gets pulled when you apply for any form of credit, let's take a look at where these lenders are actually pulling your credit score from. So in the US, there are three major credit bureaus. They are TransUnion, Equifax, and Experian. And anywhere that you have a line of credit open, whether it be a credit card, a mortgage, an auto loan, or anything else, they will report your payment history to these three bureaus, and then these bureaus will use that information to score you and give you a score. Now, not every institution reports to all three bureaus, so each bureau might have slightly different information on your financial profile, which is why they will have different scores. So when you apply for a loan, you're typically working with the median score across all three. So let's say you have a 750 at Experian, a 730 at TransUnion, and a 710 at Equifax. What your score would actually be would be a 730, as that's the median score. Now, all three bureaus have a website where you can create your own account and view your credit score for free. They also have paid options for even more services, but most people don't need them. Now, it is a good idea to go to all three bureaus and check your credit score before applying for a loan, so that way you know a better idea of what your loan or your credit score will be. Now, these numbers are not going to be the same as what your lender pulls, again, because there are multiple different types of scoring models depending on what type of credit you're applying for. But this will give you a better picture than if you just look at the credit score in your banking app. And the other thing that you should do when you are looking at your reports with all of these is to make sure that there's nothing that is inaccurate, because that happens more than you think, and your score could be hurt by something that you didn't even do. So in that case, you can open a case with that bureau and try to get that inaccuracy removed so that it helps your credit score. So how is your credit score actually calculated? Now, there are some differences between each scoring model, but for the most part, they'll look at 5 major things. The first of those is your payment history. This is making sure you have no late payments on anything, whether it's your credit card, your mortgage, your car payment. And if you do have any late payments, those will typically stay on your report for 7 years. And if you file any type of bankruptcy, depending on the type of bankruptcy, it'll stay on your report for either 7 or 10 years. Now, the longer it has been since that late payment, the less it affects your score. But a very recent late payment can dock your score anywhere from 50 to 100 points. And since payment history makes up 35% of your score, it's very important to make sure that you're paying everything on time to keep your score as high as possible. The next thing is credit utilization, which makes up 30% of the score. So every month, your bank will send a statement to the 3 credit bureaus that shows how much of your credit you actually used. You can see this in your account, what day this happens, under the statement date. Now, for example, let's say you have a $10,000 credit limit, and on that statement date, it shows that you spent $5,000 of that $10,000. So your credit utilization will be 50%. Now, for a good score, it's recommended that you keep your utilization under 30% by that statement date. And for a top tier score, you keep it under 10%. Third aspect of your credit score is your length of credit history, which makes up 15% of your score. So this is just how long have your credit accounts been open and what's the average age of your account. The longer that you have credit open, the more banks are willing to trust you and the higher your score is. The fourth aspect of your score is credit mix. This makes up 10% of your score. All this is they want to see that you have experience with different types of credit, whether it's a car loan, mortgage loan, credit card. The more types of credit you have, the more it increases your score. Now, opening multiple credit cards does not increase your credit mix because it's still the same type of credit. So having different types of credit will increase your credit score slightly. The last aspect of your credit score is recent inquiries, which takes up 10% of your score. So anytime you apply for new credit, that lender will do an inquiry and pull your credit report. And every time they do that, that's counted as a hard credit pull, which can temporarily dock some points off your score. Now, whenever you're shopping for a mortgage, if you're shopping with multiple lenders and they each pull your credit, if it's within a 1 month period, that'll typically go down as only one hard inquiry because it's showing that you're shopping for that same mortgage. But if you apply for 5 different credit cards a month, that might show up as 5 inquiries and hurt your score. So you want to be a little strategic about when you apply for new credit. So let's say your credit score isn't where you want it to be. How can you improve it? Well, there are a few things you can do. First, make sure that you're making all your payments on time. Since your payment history is the biggest part of your score and late payments really hurt your score, it's really important to make sure that you're making all your payments across all your types of credit on time. The next thing you can do is pay down your balances. So if you have high credit utilization, one thing that you can do is pay down some of that balance before the statement date, since your banks only report your balances once a month. So if you pay your balances down before that statement date, it can make your credit utilization look a little bit better, so that way you can increase your score. The third thing you can do is keep your accounts open. So especially your older accounts. Since length of credit is a portion of your credit score, keep your older accounts open so that way those accounts can continue to help your score. Now, the fourth thing you can do is make sure you dispute any errors. Go to the websites for Experian, TransUnion, Equifax, and if you see any errors, dispute them because this could be something that could improve your score right away. Now, the last thing you can do is be patient. If you've been making a lot of late payments, then it will take some time to improve your score. But since they do fall off of your score eventually, and they stop affecting your score as much as time goes on, being patient and starting to make your payments on time and improving your credit utilization will improve your score over time. So we've talked about credit scores, what they are, how to improve them, who scores them. But one thing that really gets missed when we talk about credit is what a credit freeze is. Now, before we talk about that, let's understand why it's important. So when you apply for a loan, you will provide your date of birth, your name, your social security number, and some other personal information, and the lender will use that to pull your credit report from all 3 bureaus. But let's say somebody else gets access to your information, and they use your information to apply to a lender. They get approved for a line of credit, and they use that credit in your name. Let's say it's a credit card. They run up a big bill. Don't pay it off. Now, this is identity theft, and it's against the law, but you still have to deal with this now because you have to now go file a police report. You're on the hook with the bank until you can prove that it's fraud. And in some cases, these criminals don't get caught. So a credit freeze exists to protect you from this. And most people don't even know it exists. But what a credit freeze does is you can go to all 3 bureaus and place a credit freeze. So even if someone has all your personal information, the lender is not able to pull your credit. They can only pull the credit when you lift that freeze. So if you haven't already, I would highly recommend you go and make an account with all 3 bureaus today and place a credit freeze. Now, whenever you are actually applying for a loan, whether it be credit card, auto loan, mortgage loan, you do need to lift that freeze. So that takes about 5 minutes online to do across all 3 bureaus. You just log into your account and temporarily lift that freeze. And as soon as the lender has pulled your credit, you go ahead and freeze it again. So if you haven't done that already, do it today to protect yourself from identity theft. All right, let's recap. We learned that your credit score is a 3-digit number that signals to lenders how risky it is to lend you money. And the higher your score, the better your loan terms, interest rates, and other factors depending on the type of credit you're applying for. We learned that in the US, there are 3 major credit bureaus, TransUnion, Equifax, and Experian, and they each have slightly different scoring systems and slightly different information to work off of, which is why the credit score that you see in your banking app does not always line up with what a lender will pull. We learned that your credit score is made up of 5 major categories: your payment history, your credit utilization, your length of credit history, your credit mix, and any recent inquiries that you have. And lastly, we learned why it's important to go ahead and place a credit freeze to protect yourself from identity theft. If you found any of this helpful, consider subscribing, because I post videos like this every week explaining personal finance concepts in a way that's easier to understand. Now, if you're in the home buying process and you're in North Carolina and you want some more information or you want a free quote, you can go to mortgagewithprice.com, where you can reach out for a free quote, reach out for a free consultation, or use our calculators, or read our blog for any information on some other confusing topics. The link for that is in the bio. So, see you again next week.